Hello guys. Good evening. Here is yours Titus, a data scientist. As today we will be focusing on our usual business, that is financial data statistics, narrowing down to correlation and regression predictions for businesses. And here I'll be focusing on how regression and correlation is important in financial data statistics. These calculations from correlation and regression for businesses predictions can help us in the data industry to transform or to transition or to help us use the transaction data in making various decisions in the market. Therefore, having such an important, this is a very unique calculation that can also be used to check what we call the loan default risks, the stock prices or share prices in digital market, and also you can use it to check what we call the customers churn. Therefore, in the regression and prediction, you use a very unique formula called Pearson correlation formula, which has several steps. And step one, we will look at what we call variables. It has to use variables, and one of the variable is dependent variable, and we have independent variable. Dependent variable y, which will carry what we call unknown. We don't know the price of maybe a stock for a particular company coming next week or next month or next year. We don't know. That is dependent variable y. And then we will have independent variables, where we will be checking on independent variables, that things that we already know. For example, our share index. If you are dealing with the digital stock market, the last week closing price or the last month closing price, the average means or the something that we already know, like trading volumes, and all of those things, they will really fall on dependent variables. Then, having that, you have to move to the second step, which is very important. This second step is checking the correlation. You have to check the correlation. Why are we checking the correlation? We are checking the correlation to test what we call the linear relationship of the variables x and y, because we will have both dependent and independent variables. For example, if you have a closing price and a trading volume, that's a kind of a variable, and you have to use it, especially when you are dealing with the stock market or digital market. There must be an independent or dependent variables based on what you are checking for, be it the customer churn, the default loan risk, or you are dealing with the digital asset market like stock market. So how do you test the correlation? You use the Pearson formula, where we have the Pearson correlation coefficient R, which will equal to the summations of the individual data points, where you will have now the data from the original maybe transaction data or where the data you will have. We will have to establish now the calculations based on the previous videos. You can check where we started the statistics. The more we go learning, the more we go on learning these things, the more they deepen and the more they become interesting. So you'll find that they apply the basics calculation of statistics. They will apply here, and you will go deeper and check the correlation by using now the same formula. You'll have the language of calculate the average means, calculate the individual data points. We'll have to calculate the what you call the standard deviations and how far the data is from the individual means of the all n observations and all that. So the formula simply carries the combination of basic statistics, just from calculation of the mean, calculation of the data point, calculation of the standard deviation, and all that. What has been added on this case is the correlation coefficient, which is the Pearson correlation coefficient R on this case. Then we will have now to fit this into multiple regressions, and then finally we will have the output interpretation after we establish our calculations and see the unknown, which is the prediction of the next week's price or the risk of default, loan default risk, or the customer's churn, based on what you are calculating. Therefore, then concluding this, we will also have an interesting conversation on how you can know whether the product direction, where is it heading? Is it on positive direction or in negative direction? And how can you test it using the sums of the products of deviation? And that will be the calculations that we are eagerly waiting, and we shall do it on our whiteboard as usual. Keep learning with Didaskill Academy, a digital online school of excellence. Thank you.